Hello, thanks for joining us today for the 2022 first quarter investment performance update for the San Diego Foundation. I'm Matt Fettig. I'm the Chief Investment Officer at the San Diego Foundation. Let me start with some macroeconomic thoughts. There is quite a bit going on since the turn of the new year. It's clearly been reflected by market volatility and a lot of it. The first quarter was really a historical period where you had both stocks going down at the same time that you had bond prices going down. And typically what we find is that during periods of stock market volatility, bonds tend to go up and protect capital. So what exactly happened? Well, we came into the new year and the Federal Reserve acknowledged that the inflation we're facing in this country is more than likely going to be tougher to deal with and longer term in nature than short term. And as a result, the Fed's primary tool for combating inflation is to raise short-term interest rates. In the first quarter, it became very apparent that the Fed would take an aggressive path towards raising interest rates, and that spooked the market. And as a result, inflationary assets like oil and gas, other commodities, etc., appreciated dramatically, while areas like technology that held the highest, kind of the higher valued companies in the stock market really took it on the chin. Meanwhile, you had the Russian invasion of the Ukraine during the first quarter, which further exacerbated matters with commodity prices, particularly in oil, gas, and other food commodities. And it really set the backdrop for a volatile period where, believe it or not, intermediate term bonds, which are typically what institutions like us tend to utilize, underperformed stocks. They were down more. And what you will see as we walk through the performance update slides is that some of our most conservative portfolios, those that held more bonds than stocks, actually ended up underperforming those more aggressive, higher risk portfolios that had more stocks than bonds. Now, as we sit here in May, towards the end of the month, the market has continued to depreciate in both April and the month of May. And we will be talking more next quarter about some of the things that are happening, but it is largely the same forces at work. While the economy has been strong and job growth has been strong, the job market has been very strong, the unknown threat of these higher interest rates is weighing on the market, and some worry that the Federal Reserve will just raise interest rates and drive the US into a recession. We don't have a crystal ball, nor does anybody else that is consistently working. And therefore, we won't make predictions about what's to come. But it is safe to say, after a period of 12 years, there's been very little market volatility, and volatility is now back with a bang. So let's look at the results of the various San Diego Foundation portfolios, starting with the endowment portfolio. Very proud of these numbers, never proud to lose money. But as it stands, given how difficult the first quarter was, the endowment portfolio was down 1.5%. The policy index, our benchmark, was down 1.8. And you can see over longer periods of time, the endowment portfolio has handily beat the policy index, producing strong rates of return. To put this in perspective, we rank our results relative to other nonprofits that have similar size portfolios. And the returns for the quarter, the fiscal year to date, the 1 year period, and the 3 year period all rank in the top decile. That's within the top 10% of other institutions. Over the 5 and 7 year, that ranking is in the 20th percent, 1 being best, 100 being worst. We have tools in the endowment that allow us to diversify our assets and protect not all capital, but a good amount of the capital in down periods. That's not to say that these results won't get worse as we head into the second quarter. They likely will, because the markets were down more in April and May to date. But very strong results for the endowment for the first quarter. And you can see the 3-year numbers in double digits. Very proud of that. The next page is the long-term portfolio. The long-term portfolio also fared well for the quarter, though it was down 2.6%. It did outperform its policy index by well over a point. We have this portfolio positioned to be fairly aggressive, with just about 50% in stocks. But we also have this bucket you can see on the left in the light blue called hedge funds. And hedge funds for the San Diego Foundation are defensive portfolios that are designed to protect capital during market downturns. And fortunately, with 20% or so of the portfolio in hedge funds, we were able to do that. Our hedge fund portfolio produced a positive rate of return for the first quarter and helped to dampen some of the volatility that went along with traditional stocks and traditional bonds. Next page, we're going to look at the medium-term portfolio. And to my comments earlier, the medium-term portfolio was down 5.2% for the quarter. And this is designed to be a more conservative portfolio than the previous two that we looked at. So how does that work? How does a more conservative portfolio ultimately lose more money than a more aggressive portfolio? And it is an issue that we're all scratching our heads over. The reason is simple. This portfolio has 70% of its weighting in bonds and 30% in stocks. Bonds fell more than stocks for the quarter. But we don't normally see that happen. And in fact, you have to go back to the great financial crisis of 2008, 2009 to find a period where bonds fell as much as they did in a single quarter. At that time, it was really over credit concerns. Today, it's over interest rate concerns. And we know that as interest rates rise, bonds have an inverse relationship with interest rates and bond prices fall. And that is exactly the phenomenon we saw in the first quarter. And that is the reason why this portfolio fell more than others. Interest rates had continued to go up after the end of the first quarter, but seem to have found a little bit of stabilization here in the month of May. We'll have to see how this continues to play out. But it just happens to be one of those weird times when this phenomenon takes place. And it's unfortunate for our investors, but for all investors around the globe who were in more conservative vehicles and ended up losing more money than they would have being invested solely in the stock market. The intermediate term portfolio is similar. It is designed to be a conservative portfolio. 100% of the assets are in fixed income or bonds. And as we mentioned, bonds fell. The intermediate term benchmark for bonds was down 5.9% for the first quarter. This particular portfolio has about 40% of it in shorter term fixed income instruments, which are not as sensitive to rising interest rates. And that's why it fell less than 5.9%. However, down for the first quarter and likely to continue to face some headwinds here, at least so far through the second quarter. And then we have our short-term portfolio. So as you see here, the short-term portfolio is comprised 100% of money market funds. Money market funds are highly correlated to short-term interest rates. What is happening is as the Federal Reserve has began tightening and raising interest rates, there will be a period it will likely take a few more hikes where we start to see some yield from money market funds. So ultimately, that means if you're in the short-term portfolio, you've been receiving nothing for several quarters in a row because short-term rates were at zero. As short-term rates continue to raise above zero, you will begin to see some yield come back to this portfolio. Stay tuned for that, and we'll talk more about that once we start to see it happen. And then last, I want to talk about our sustainable portfolios. The sustainable endowment and sustainable non-endowment portfolios are invested roughly the same. And if you recall, in 2020 and 2021, these were our best performing portfolios. Why? Well, number one, they were invested pretty simply, 70% in global stocks, 30% in bonds. And that worked. But also remember, we've been in a long-term period where oil and gas and other commodities have been on the decline. This particular portfolio is a values-based portfolio. It divests from fossil fuel producing companies. And lo and behold, in the first quarter of this year, if you look at the S&P 500, there was one sector of the 10 that was strongly positive, up over 30% for the quarter. That was energy. This portfolio does not own those energy companies. And so when you strip out that energy exposure, you were left with one sector that was modestly positive and 8 other sectors that were down quite a bit. And you can see the impact it had for the quarter. This portfolio underperformed the policy index, largely due to the lack of that energy exposure. Flip to the next page, and the story is really the same for the non-endowment portfolio. Without the energy exposure, taking away one sector for value-based reasons can have some pretty significant effect on performance to the upside over 2020 and calendar year 2021. And then obviously to the downside so far here in 2022. That concludes my remarks for today. We will spend some more time with you on the macroeconomic economy update at the next event that we hold. And I just want to say that if you are having any questions or concerns about your assets here invested at the San Diego Foundation, we are just a call away and happy to field those. We know it is difficult in a period of market volatility like we're going through today, but we're here to answer your questions should you have them. Thanks so much, and we appreciate you joining.